So yeah, we're lucky enough to have Anton Kreil here. He started his career with trading at about 16 with his own money, and then got recruited into Goldman Sachs, headhunted to Lehman Brothers, JP Morgan before retiring, traveling the world. Then you may know that he also did a BBC program, $1 Million Traders, and proceeded to form his own company. And next year he's going to travel to space, hopefully. So yeah, it's a pretty ridiculous career. I think we're going to learn a lot from this interview. So if we could just have a warm welcome and a round of applause for Anton before we start. Okay, so let's make a start. How did you get into the world of trading?
Started trading pretty young, as you mentioned in the introduction. Started when I was 16, basically. So grew up in Liverpool and was watching documentaries on television about the markets. So this was like 1994, 95. And there was a lot of documentaries on TV about Thatcher's Britain and how lots of guys in the city were making lots of money. So I was watching these documentaries thinking I could do it because I'm clever than these guys. So literally opened a trading account with a local stockbroker in the north of England. And back then it was all physical stock. So you couldn't leverage or borrow money to trade. So it was one-for-one cash trading in physical shares, and really got into the IPO situations where you could buy stocks in the morning, where you put in for the IPO allocation a few weeks earlier. You get the IPO allocation and without even paying for it, and then you can flip the IPO like at lunchtime if it goes up, 50, 100%. Because it was all T+3 settlement. So you used to have to send a check to the stockbroker and then it'd be settled in 3 days. So you were able to flip IPOs and not actually pay for them. So really got into it that way.
Okay, and you continued trading at university?
Yeah, so at university, it was 97 to 2000. So I was pretty lucky. I caught the tech bull market, the tech boom. So flipping IPOs and trading IPOs was actually really straightforward. And university day used to be get up at 6 a.m., do an hour's research, market would open at 8, put on my positions, go to lectures, lunchtime, go in the computer room, flip them. But most of it was already done over the telephone. So in my day, wasn't so long ago, this was before broadband. So everything was dial-up. And, at home, it used to cost like £1 a minute to plug your internet in. So, and you used to only get quotes online. And when you pick up the telephone to trade, the quotes from the brokers would be totally different from what you see on the screen. So it was pretty slow and spreads were really wide. So you had to trade very volatile situations and then go home in the evening, do a bit of research and do the same again the next day.
Was it that experience that got you into Goldman Sachs?
Pretty much, yeah. The Goldman Sachs situation was, typical situation where they come around on the milk round and do presentations. So obviously, first, second year university, you go to all of these and you get to know all the companies. I'm sure here you have the same even today. The track record, which is just all of your trades that you've ever done and your performance and your risk over return. The track record, I basically told one of the traders on the desk at the presentations, the amount of money that I made at university, all the situations I was trading, and they were really interested. So I basically had a telephone interview the next day and emailed them my track record. So the telephone interview was with the head of the desk, and then I was invited down the next week to have interviews and then offered the job on the same day, basically.
Okay. Do you think that method still applies for getting students into for us that want to follow in the same sort of path, do you think that's the right way to go about getting a job, getting a trading job now?
One of the big problems with applying to investment banks, hedge funds, all financial institutions really, is a lot of the industries are in structural decline at the moment. So you're seeing investment banks culling tens of thousands of people in the Western world, hedge funds pulling back on hiring, the insurance industry pretty much the same. But the amount of applications has gone up exponentially in the last 10, 15 years. Everyone seems to have an undergraduate degree now. Everyone has a master's. So, differentiating yourself is really, really hard. Sure. In my day, the way I differentiated myself was by doing as well. And I think it still really applies. If you can show something on your resume and show something in your experience where you've actually applied real trading methodologies and used real money, you stand out in a huge way. Everybody's got an undergrad with a 2-1. Everyone's got a master's. When I used to see CVs, I used to hire a lot of people in the industry. Piles of CVs would drop on my desk from HR, and HR is really just a filtering process. They don't know what makes a good trader, but the people tick all the boxes, so the CVs end up on the desk. But there's thousands of them, and it's literally sometimes just taking them and going 2-1, masters, couple of good institutions that you went to, nothing really interesting about this person, bin.
Sure.
I mean, that sometimes that can be the process.
Right. Okay, so you're already trading. Once you're at Goldman Sachs, how did they develop your ability?
Well, publicly, these companies are public companies, so they're always going to say that they have official training programs. It's something, public companies have to show their shareholders that they're being responsible in training the people that they hire. So you do have an official training program that you go on in New York, which is pretty much sitting in a lecture theatre like we're here now for a couple of months. But also you're given a seat on the trading floor on Wall Street. To be honest, what you learn in that situation is really about applied finance, more that you would learn in a master's. But also the culture of the firm. And you get to meet everybody and all the right people in the US office. So you don't really learn how to trade or learn about your profession in practice. That's when you come back on the desk, and really that's where you learn.
Okay. So you spent about 4 years at Goldman's. What were your highlights?
Highlights, well, walking onto the desk in the first week, where it's all hands to the pump because it was the tech boom. So this would have been June 2000. And where they just give you, it was crazy. So they just give you a pot of money. With me, it was $10 million to start. They say, learn how to trade. This guy next to you is going to teach you what to do. Press this button to buy, press this button to sell. And because it was the tech boom, it was every day walking in with pretty much very little experience, saying, right, we're going to give you some responsibility today. After a couple of weeks, you're going to IPO this company. And I'm like, okay, so I'm on the other side of the IPO now that I'm used to. And then next day doing a rights issue, raising capital for companies. Next day selling stakes in companies for large shareholders and pension funds. So yeah, the first couple of months was a real baptism of fire. I thought I knew stuff. I didn't know anything until I walked onto that floor. I guess big trading situations. There's so many, but ones that really stand out. Probably during the tech boom, doing all the IPOs. 2001, September the 11th, huge situation in the market. The recessionary periods of 2002, and then the takeoff of the market in 03, 04.
Okay. We'll have a little pause now and get some audience questions, if anyone's got any so far. If not, don't worry.
You've looked at both sides, you've looked at both trading and also the investment banking side.
Yeah.
It's really important for people who are trading, doing just one of those, to have experience in both. Do you think that helps you to become better at either one, or because there's a lot of people who are really good at one part?
Yeah, I really think so. I mean, you've really got to do it in practice with real money. If you get the experience doing that, even if you lose a little bit of money, you've got to see it as paying for the education of trading with real money. So even if you lose money and say to an investment bank or a hedge fund, this is my track record, I lost a couple of £1,000 last year trading, they will look at that favourably. So you've got no downside in doing it. So as long as you show that you've done it and you've traded for a year, and they say, well, what lessons have you learned? Well, I've learned not to do this. I've learned not to do this. The market last year was really tough. The fact that you're actually doing it means you're going to learn faster. So because there's a great saying, you're not trading until you've got a position, right? Or you don't know anything about a stock until you've got a position. So once you have a position in something, you're forced to learn and monitor your risk. So I think it's really, really important to do it. And then going into the investment banking side, it is very, very different. So the approach to trading is very different in investment banks and hedge funds, the way professionals do it, compared to the retail trader or the man on the street. So you'll learn how to do that, but from the ground up, just having a position will teach you a lot.
Is there any particular area that you'd recommend someone who has a little experience in the markets, like Forex or equities? Is there any area that you say better suited to beginners?
I would say, okay, in terms of volatility, volatility creates opportunities for traders over any given time horizon. And that's what traders live and die on. They need volatility. Otherwise, you can't make money. So the Forex market, implied volatility over the last couple of years has been absolutely crushed. We've actually seen it tick up a little bit recently, especially in dollar yen, huge moves. Forex is good to learn in, but don't expect to make loads of money if you're day trading, because actually the volatility of Forex at the moment, of the major G10 currency pairs globally, is very, very low. So it's very difficult to make money over short periods of time. In equities, generally, historically, volatility is higher than in Forex. So you're looking at major indices versus major currency pairs. Major indices are 1.5 to 2 times more volatile than major currency pairs historically. And that's over 50 years of data. So it's pretty significant. What I would say is split up your positioning and be a little bit diverse, where you've got exposure to equities, at least half or the majority, commodities and Forex, and maybe some cash and interest rate situations where you can take tiny positions or day trade essentially with opportunities that happen in very small periods of time. I think your time horizon really, if you're starting out, should be 1 to 3 months on every position across the asset classes. But percentage split, personally I do 65% equities because that's probably the most volatile asset class, 20% commodities, 10% in Forex, and keep cash or margin in reserve so you can actually take advantage of very short-term opportunities.
Anyone else? Yeah.
For example, when you want to start trading, the first issue coming with it, you have 100 different brokers, and in your opinion, which criteria should we use to find the right broker?
I think it's important to know whether the broker's taking the other side of your trades, first of all. So, I mean, what you'll find, there's a lot of conflict of interest in the industry when you're a retail trader. There's obviously the commission situation and the spread situation. Just because spreads are tight and commissions are low doesn't mean it's a good thing, because all that means is that the brokers are going to try and turn your account over more aggressively so you pay them as much money. So they'll be telling you to do things that aren't necessarily good for you. So obviously cost of trading is an issue. But I think it's really important that you find brokers that aren't aggressively taking the other sides of your trades, because that's a huge conflict of interest. So, you know, in the products like spread betting and CFDs, a lot of them still do. So they go unhedged on the other side of your positions. So they would actually prefer that you didn't make money.
We'll take one more, yeah?
So you see sort of the kind of downside of brokerage fees reducing, and fees obviously cracking down. Trading obviously has always been divided between trading and broking. Obviously, is you see what the brokerage can take more of an advantage in that sense of the, like you say to that chap there, the trading in that sense.
Listen, there's no doubt about it. Trading's become cheaper, which isn't great for the brokerage industry. But what also happened for the brokerage industry in the last 10 years was the switch from dial-up to broadband. So the market size is now much bigger than it was 15 years ago, because now everybody can trade from their bedroom. So the market participants are far greater than they used to be. So the brokerage industry overall has been downsized. I think broking actually, when you're starting out in the markets, it's quite good to be a broker for a couple of years, because you can learn a lot of things that happen on the other side. So when you actually go out and trade with your own money or other people's money, you know where the conflict of interest lies. Yeah. So you can actually talk to people in this language and totally understand their business. So I think it's quite healthy to do it for a couple of years, because you'll learn about it. You know, my function in the investment banks was twofold: market making and proprietary trading.
Is it easy transfer from broking to trading?
It's not that easy, but as long as you go into it from the outset and say, I'm only going to stay a couple of years, and make people that you want to work for understand that the reason why you're doing it is to learn, you know, not for the money and to rip people's faces off. Yeah. Then it's okay. It's quite healthy. People will look on it favorably, but you've got to obviously have context, and you've got to go into it with the mindset that you're not going to be there forever. You're only going in to learn so you can go elsewhere.
So you've worked at 3 of the biggest investment banks. Would you say there's much of a difference in the culture, or the culture of success between the banks?
I'd say there's a massive difference between Goldman Sachs and the rest of the market. Obviously, I'm going to be biased because I started there, but you know, back then, even I would say even now, like the best people in the market work there, and you know, they're not unapproachable people. You know, they're generally just normal people, but with a very strong work ethic and intelligence. That's a different type of intelligence to the rest of the market. It's a curious mind, but with a very, very strong work ethic, but also very entrepreneurial as well. You know, being able to create new products, create new situations that there's going to be a lot of demand for, and this type of innovation, I think it's very important in financial markets, because to satisfy client demands in financial markets is very, very tough, because it's a very overbroked market. Goldman are head and shoulders above anybody else in terms of doing that. So, you know, if I'm going to be biased, obviously the culture there is very, very different to the rest of the market. You know, for me, the culture when I was around, because I think it's dependent on the time that you're in the market, the time you're actually a professional. I saw the culture in the city generally change from a culture of working for the company and making company profits to a political culture of greed and trying to make money for yourself rather than for the benefit of the company. So because there was a lot of capacity and a lot of slack in the industry at the time, a lot of people who were very untalented were being hired to do very important jobs. So, I mean, we saw what happened in the end, but you know, the industry now has the capacity's tightened to a point where it's getting to a stage where it's about right. But back then, because of the capacity issues, the culture was very, very self-interest motivated, and a lot of it was greed, with a lot of people who were very untalented working in very important positions.
what kind of account sizes were you managing by the end of that investment banking career?
Yeah, I mean the largest account sizes were actually at Goldman, because there's more of a risk culture. So started off with like $10 million on day one. The more money you make, the more you progress. When leaving Goldman, there was a team of us, 4 people, running about $500 million on the trading desk, which was about a quarter of the trading desk's exposure. So it was the number one team. We were doing TMT, so technology, media, telecoms. Then Lehman Brothers, very strange situation. You know, walking in, most guys around me didn't have more than $10-20 million of risk when I arrived. Within 2 years, this was 2004. Within 2 years, everybody had $200 to $300 million of risk. So, you know, really at that time, guys like me were brought in to raise the risk profile of the desk. To say that it got out of hand is an understatement. That's one of the reasons why I left Lehman, because a lot of people around who were there previously with very little risk exposure, in a very short space of time had a lot of risk. So not necessarily deserving that risk. Then JP Morgan, same situation, hardly anybody had risk around. But then I come in and ended up with $100 million of risk as the limit. So at any time, $50 to $100 million. But the biggest risk run is probably like $200 to $300 million personally, but working in a team on 500.
What about the work-life balance? Was there a work-life balance?
Forget about work-life balance in those days. It just didn't exist. I mean, I remember, you know, I mean, a typical day was wake up 5 o'clock, taxi drivers outside at 5:30, you know, and you're in the office by 10 to 6. Then the market closes 4:35, but then you're trading the US till 9-10 p.m. in the evening. And then if you've got situations in Asia, then the traders in Hong Kong will be calling you at 2 in the morning. So, I mean, and then also there's a social side to the business where obviously in a bull market, traders are asked to go out all the time with the salespeople because the clients want to meet the traders, as in the people who are trading their positions. So you typically be out 2 or 3 nights a week till 1-2 o'clock in the morning. I mean, I remember one situation stands out, you know, in my mind in terms of private life. I remember starting to date this girl, and then after a couple of months, we were getting on very well, and she lived around the corner from me in North London. So I said, well, you know, why don't you just spend more than a few nights a week here? Why don't you just pretend to move in a little bit? You know, put some clothes in the wardrobe. But, you know, I spent a month basically telling her and warning her, you're not going to like it if you live with me. She's like, oh, no, it'll be fine, it'll be fine. She told me for months, it'll be fine. And then I came in from a client night out one morning at about 3 in the morning, fell on the bed, slept in my suit, got back up, 5 a.m., got under the shower, put a new suit on, and as I was getting dressed, because I used to have to get dressed in the dark, because that would wake her up. As I was getting dressed, I could feel this like presence behind me. And this was after about 2 weeks of her kind of moving in. And I kind of turned around, and she was standing on my bed, holding her hair in bunches, and just screamed at me, "What the hell are you doing?" And my response was, I guess the honeymoon period's over then. And we had to discuss the whole situation when I got back that evening. But essentially, you know, private life, Monday to Friday, awful in that market. Weekends, catching up on sleep. and then it all starts again Monday morning at 5 a.m.
We'll take some more questions from the audience, if anyone's got any.
I was just going to ask about banks. You said Goldman Sachs head and shoulders above the rest. But I mean, are there any banks that you think are moving sort of up the chain and are kind of going to be the ones to look at in the future?
It's difficult to say because I think since the subprime crisis, overall, the standard of people within that area of the finance industry has decreased a lot, simply because the compensation has been crushed. So talented people have migrated. They've migrated to hedge funds, or they trade their own money. You know, guys like myself. Guys like myself can earn as much, if not more, than we used to doing our own thing, rather than going to work for an investment bank now. So I would say it's difficult to say within the industry when overall the quality's gone down. So, you know, I think it's a really tough job now for graduates. You know, if you manage to get into these companies, I think it's a tough situation, because once you're there, from my perspective, from what I used to see and the people I used to work with, a lot of these people just aren't around anymore. So the talented people have all left. So it's a bit of a minefield that you're going to turn up and learn from people that aren't really that talented or not very good at what they do. Because if you're talented, you get paid. You know, what you get paid is I'm afraid to say, a recognition of your talent, okay? But what's happened in the industry now is it's in structural decline because of regulation. So all the talented people who used to get paid all the money, who used to be innovative, entrepreneurial, got paid the big bucks, either now work for themselves or have gone to hedge funds or left the Western world altogether, and now they're in emerging or frontier markets. So within the investment banks, I would still say Goldman Sachs is slightly head and shoulders above most banks. Culturally, I think pretty much outside of that, everyone's the same. You know, it's difficult to differentiate.
Anyone else? Yeah, come.
The only question will basically trade, apart from the boarding last week time.
Oh my God, that's a pretty open-ended question. Could be here all night. From my experience actually in the professional and retail world, because when I came out of the professional world, I'd totally forgotten what it was like to trade with your own money. Now going back to what I was talking about earlier, where when I was 18, 19 years old at uni, getting up at 6 a.m., you know, when lectures started at 9:10, you know, I look back at that and now realize when I see retail traders, probably the most important thing is you have to be a self-starter. You have to be somebody who is highly motivated to go out into the world and seek out your own information and work for yourself. Now, if you're doing it within a company, when you're working for yourself, you're really working for the company, because there's a big collection of individuals with all with self-interest called a company, essentially. And if you're on a trading desk, all of those guys, they're all thoroughbred self-starters, no doubt about it. You have to want to get up in the morning, you have to love the market, you have to seek out the information, you have to come up with innovative ideas, you have to be entrepreneurial, do business with your clients, and find ideas in the market that are going to make you a lot of money because the market hasn't realized the opportunity exists. So to get those ideas, you've got to go back to the basic, which is you really have to be a self-starter.
We'll take one more. Yeah.
Based on your experience in terms of trading, is there anything you can't learn from, I mean, as in when you trade by yourself, is there anything that you can't learn by working for investment banks? Meaning, as in if you work for investment banks, there are things that you learn which you can't really.
Well, traditionally the argument was the professionals see the order flow in the market, therefore they have an information advantage. Well, I can tell you, when you're sitting at an investment bank on a trading desk, internally, they think everybody else has the advantage. Because what they're doing is trading with, you know, hedge funds. The hedge funds are coming in, and the market makers and the traders are taking the risk that the hedge funds are giving them. So they're using the bank's balance sheet to make prices to hedge funds. Now, a lot of hedge funds in the past have been what you describe as hot money. So they come in and they know something that you didn't know, and they take you out in a stock, and you'd be short, and they'd be long, and then the stock would move 10, 20% against you. So at investment banks, traditionally the argument was from the outside, from the retail trader, and even from the hedge fund industry, well, they've got the order flow, so they know whether a stock's going down or whether a stock's going up, or an asset, yeah? Whereas the guys at investment banks think the information advantage is outside at the hedge funds because they speak to everybody, okay? No longer the case at the investment banks, really, in terms of order flow, because now everything's put in a machine. So, in the old days, you used to be able to take an order in a stock, and a lot of people would use the order to bully the stock around, push it to levels that they wanted it to go to. It just doesn't happen anymore. Everything goes in a machine, and then you've got other liquidity pools, like the dark pools, where people can trade without seeing counterparty, without knowing what level they're trading at until they get the execution, etc., etc. What's great about the internet is, honestly, now I came out the professional side, and I've done 4 years of trading with my own money again. What's great about the internet is all the information is actually there. You can actually get it all for very cheap cost or free. But what's more important is actually knowing how to interpret that information and turn it into real hard dollars. So that's probably the most important thing.
So after retiring from the banking industry, you took a year out traveling. Is that just a case of well-earned time off?
Yeah, I mean, I'm not scared to admit it. After seven and a half years, I was very burnt out. And I felt like I deserved a break. When I grew up in Liverpool, left from Liverpool when I was 18 to go to Manchester University. Went to university for 3 years, was hired by Goldman in my final year for 9 months' time. After my final exam, which was, I still remember the date, June the 12th. 3 weeks later, I was on a plane to New York, and I was working for Goldman. So, and then you have 2 weeks holiday a year. So I'd never had a break. I'd never seen the world. So I wanted to go and do that and take a break and then reassess. Whilst, I also thought the market was going down. So being short in that situation when everyone's long, you don't get paid at these places. So it's a waste of time. So, offered to go back into the industry, buy a few places, but declined. Sold my property in London and got on a plane around the world for 14 months with one bag of clothes.
So your next venture was working on BBC programme $1 Million Traders. How did that come about?
I was sitting on a beach in Brazil, drinking a caipirinha, and got a phone call from a guy I used to work with at Goldman Sachs who had come up with the idea and the concept, Lex Van Dam. And he literally point blank asked me, do you want to get involved in the TV programme? At this stage, believe it or not, travelling around the world, this was like 13 months down the line, travelling around the world, seeing jungles, cities, beaches, and bumming around for 13 months gets a little bit boring. The grass is always greener, right? But I was bored. So, this situation was literally a good stepping stone to come back into the Western world after you've been away for so long. Just come back, put yourself out there. And, I liked the concept of it. The idea that if we trained people and gave them a couple of weeks training and then gave them $1 million and just let them loose on the market whilst the market environment was the worst it's ever been, we'd probably find some pretty interesting results. So, from the outset, the objective of the show really was to show two things. One, that actually anybody can trade if you get the right instruction and you're willing to work a little bit at it and you have the kind of right mindset. That's the first thing, but also that it's actually quite tough. Not everybody can do it. So I think, you know, a lot of people in the market, like this gentleman over here, we were discussing the conflict of interest earlier. Due to this conflict of interest in the retail brokerage market, you'll get told by a lot of people that anyone can trade. You know, you'll get emails all the time. Make $10,000 a month in the international forex markets. Yeah. The problem is that not everyone can do it, and a lot of it is lies. So you have to be very, very careful. So we set out, you know, with an objective to prove that people can do it, but in a certain way. But not everyone can do it, and I think it was, you know, pretty successful.
Okay, so well, by doing that, you must have created a public image. So how did you deal with that, or how did that affect your life?
Well, when I came back, I was in terms of timetable. What happened? I came back May 2008. Started filming the TV program 2 weeks later. We actually did filming here, upstairs. And actually next door in the rooms here, we interviewed people, and then we did most of the training upstairs. But in terms of timetable, the show took about 10 weeks to film, and then we finished filming on August the 31st, 2008. And then I took off again. I went traveling for another 4 months. Because it was, you know, I wasn't here for any reason except that. And then the show was aired January, February 2009. And then I was back in London again and renting an apartment by Tower Bridge. It became a bit weird, if you like, because I'd used to walk into the city to see my old buddies and workmates, you know, for lunch. We'd be sitting around, and there was one situation which was a bit weird. A guy ran across the street and picked me up and started hugging me. He's like a guy in his like mid-40s. I was like, okay, yeah, can I help you? He's like thanking me. He's like, thank you so much, thank you so much, thank you so much. I'm like, why? He's like, my wife now understands what I do for a living. But then there's other uncomfortable situations. You know, that's good stuff to know, but it's a bit uncomfortable. You know, there's other uncomfortable situations, like I was out maybe a month or two after the show had finished, and a bunch of guys in the city were all drunk, and they just surrounded me in a bar and would not let me leave. They were like, you're staying out with us the whole night. And they were just giving me drinks and drinks and drinks and just forcing me to stay out with them. And like my friends were leaving, and I'm like, I can't believe I've got to stay out with these people who I don't even know. So, yeah, it's weird because like what you know, it's a great experience doing a TV program. So I think what you learn from it is that people really think that they know you when they don't. So when you've actually been in someone's living room for an hour every Monday night for a month, they think you're their friend. Yeah. And so when they see you, they embrace you as a friend. And you're kind of like, well, I don't even know who you are. Yeah, so it gets very uncomfortable. And then obviously, you know, with time that dies out. But I had to move out of the centre of London. I moved to the suburbs for a few years. Yeah.
Is there any more questions at this point?
Back in days on the trading floors, when you was trading, like losing or gaining money, have you got like a gambling addiction feeling?
It's hard to say no to that question, because you do get those feelings a lot when you're in a very fast-paced environment. The trick is learning how to suppress it and trading in a non-human way. So what you'll realize if you do a lot of psychology work, humans are very bad traders, because the human psychology is the opposite of how you should actually trade. So all of these feelings that you get as a human, you have to suppress. And that's part of the learning process. And you become kind of hard-coded over many years, where you know when you get this feeling, you push it away, and then you carry on as you should. So yeah, I can't say no to that question, because you do actually get these feelings, but you have to hide them. You have to push them. And then you can go outside the office and do that if you want, but you can't do it on the trading floor.
For the reason you just said, humans are bad traders, for that reason, do you think that the trading industry, right, is at risk of becoming more orientated to using computers that literally use models like the fact they and predict what's going to happen?
Yeah. Well, I would say one thing I've learned in finance and in theoretical finance, the extremes always break the model, okay? So on one side, humans can't trade. On the other side, computers can't make rational decisions, right? In situations where the world is now different to what it used to be the day before. So when big things happen, humans have to intervene and turn the computers off. We're still yet to see whether a computer can trade through a stock market crash, right? And actually make money. So I would say, the industry has definitely gone more computer-driven, algorithmic, more quantitative, yeah? What's that done to the industry? It's taken a lot of the short-term opportunities out of the market. You know, when you see things that happen at the moment in the industry, you know, rental prices around the London Stock Exchange in Paternoster Square have gone through the roof because all the quants traders want the fastest connectivity in nanoseconds to the exchange, okay? So they can beat the other algorithms. And you see algorithms that are built solely to predict what other algorithms are trying to do, right? So if you're a day trader, what chance do you stand? You don't. Because, you know, these machines are just going to beat you on a normal day when nothing's going on, yeah? But when big things happen, humans have to intervene. The machines have to be switched off. So in terms of the world becoming more orientated in that way, absolutely, it will be, and it will continue. What does that mean for human traders? It means short-term opportunities don't exist, or they exist a lot less than they used to. So you've got to have a much longer time horizon and a different approach. So, you know, that's why my approach is 1 to 3 months. I don't need to worry about the machines on a minute-to-minute basis. I don't care.
Last one, just here in front.
As a trader, we probably were working with a lot of past data, using the charts and trends. And was your success due to the fact that you could compromise all this behavioral view, the fundamentals, and the charts?
Okay. Listen, I don't profess for 1 second that technical analysis is not important. It is important because it provides a very good head check to overlay onto fundamentals. So when you've got a fundamental predisposition where you've done all your work on a situation and you believe that something's going to go up massively in the next year, and then you check the technicals and it says you're going to be wrong for the next 2 months, then that goes on the watch list and you wait till it actually turns in your favor. Then you jump in and then all the planets are aligned. So you need to have, you know, that kind of discipline to overlay technical analysis onto fundamental analysis. But then, you know, people who use 100% technical analysis, you know, when something breaks a trend or when something breaks a range, you know, it's happening for fundamental reasons.
Did you come up with your own methodology, or how come you reconcile these two views?
No, I haven't invented a fundamental model. I haven't invented a technical model. I take the best of everything that works and put it into my own processes, my own system. Yeah.
Okay, so did you, by training these people on BBC $1 Million Traders, do you think you sort of gained your inspiration there for forming the Institute of Trading and Portfolio Management?
Well, I mean, for a year after the TV program went out, I actually went and hid in the suburbs and traded with my own money and really got back into that again. But at the same time, I was just getting messages from all over the world And in total, probably within 7 to 9 months, about 5,000-6,000 messages from people around the world saying, can you please teach me? So then I was getting a bit bored, trading from home and spending 1 day a week in the office. So I thought, well, I should actually go out and teach people. So I put together a course, which is basically, I just put my brain on paper in trading and then tried to make sense of it and put it in a language that everybody would understand. And then went out and did like a 10-week tour of the UK, starting in Glasgow and finishing in London. And the idea with that was to go out and do it and see if people really understood what I was talking about. Because, spending that amount of time on the professional side, when you come out of that and you start talking to normal people about trading who haven't ever done it before, are they actually going to understand what the hell you're talking about? So you have to go and test it, and you have to go and teach people and see what they think and see what the response is. And pretty much after 10 weeks, 90% of everything that I was teaching, people understood. So then I had to rejig the other 10% and then started actually the current situation, which is the Institute of Trading and Portfolio Management.
Okay, so tell us a little bit more about that and like what you're trying to achieve for your students.
Yeah, so to begin with, right away, it was just going on the road, teaching to see if people understood. The business was set up literally on $70. So I paid $70 online to get the logo and then called up the newspapers and said, I'm that guy from TV. Here's my 10-date tour of the UK. I'm going to tell everyone how to trade. And then it was in the papers, and then it sold loads of tickets. Yeah. So then organically grew from going on the road and just testing to actually people doing it for real and opening trading accounts and seeing if they can actually trade from what I've taught them. What it's grown into now is we've got over 80 traders where I basically sit in the back and I can see all the positions, and everybody within the institute who's got their own trading account is just a normal person. They've got day jobs, they're students, etc., etc. The objective is always, number one, the community has to make money. So overall, the community is up, because that basically says that what I'm teaching works. There's never been a month in 2 years where the community is down. Second, a very high percentage of people make money relative to the industry average. So I know you shouldn't measure yourself relative, but in absolute terms, the highest percentage possible of people to make money. And then when you measure yourself relative, you should be outperforming the rest of the industry. So the industry average, believe it or not, is that 80 to 90% of retail traders lose money. What do we get? 60 to 65% actually, their accounts are up. And then the rest are either flat or down, but down small. So we try and protect people from themselves. So we don't allow them to take too much risk if they're losing money. Then they learn over time how to protect their own downside and then make money with their own money. So what's actually happened now is that because of track record, you have to trade for at least 12 to 18 months before really someone can turn around to you and say, you're actually pretty good at trading. I'm going to give you money to trade with. Because in the last 12 months, you've made money 8 months out of 12. And in the months where you lose money, you do the right things. In the months that you make money, you do the right things as well. So you have good behavior as a trader. And out of the 100 trades that you've done in the last 12 months, you've got a win ratio of 55%. And you actually suit other metrics as well that we measure you on in the back end of the system. And now what we do is we either give people money to trade ourselves after 12 months or from external investors, or we take people's track records and we sell them to hedge funds. And the hedge funds pay us based on the guy coming in as a percentage of their basic salary over 2 years. So not out of the basic salary, but measured against it. So if somebody gets paid £250,000 over 2 years, our consultancy fee to the hedge fund can be £125,000. So, you know, what this does for us is great, because in terms of education, there's no hiding. It has to be good, because when I go and see the hedge funds and say to them, I've got a guy here who in the last 12 months has done well, made money, I think you should take a look at them. They suit your fund and what you're trying to achieve. What's the first thing they turn around and ask me? Well, how's the guy being taught? How's that person being taught? And I have to put what I teach in front of them. So the fact that I even get a contract with them, you know, for them it's a zero call situation, in that it doesn't cost them anything to sign a contract, and then a profitable person comes in, so they've got no downside. They have to basically validate what everybody gets taught. The second thing they ask, well, let me see the track record, let's see all of the trades, how much money they make, what their behavior was like in the last year when this happened in the market, when this happened in the market, etc., etc. Then after that, they have to see, obviously, like over the 12 months, the good behavior of what you've been doing in those situations. And if you've got the good behavior, you've got the right education, you're making money, you'll be interviewed. You know, we've got several funds who now sit in the back and they interview people all the time. And we've started placing people into funds. So we put 2 guys into funds in November, and a couple of guys are going into funds now as well.
Can we go into a little bit more depth as to the methods that you teach people at the Institute?
Yeah, of course. We can skim over it. You know, it's difficult to do in a few minutes, simply because the public course usually takes a whole weekend. But essentially, it's a macroeconomic, top-down, systematic asset selection process with bottom-up and technicals and risk management thrown in, attached. Because I think, you know, you, as a trader, when you're learning, you have to go through processes and checklists to make sure you're not doing anything stupid. And essentially what this is you know, from my experience over 16, 17 years, getting that on paper and all of the basics so you can understand it. And then with the course comes like PDFs and Excel spreadsheets where you're basically doing it yourself and teaching yourself afterwards. So in terms of methods, a lot of risk management that you wouldn't expect would be used, but is actually used by a lot of hedge fund managers. Top-down approach, really starting off with 42,000 assets globally and drilling down through various levels, and then getting to a point where you've got a watch list of 30 to 40 situations, and then you've got a portfolio of 10 to 20 positions. And then it's about, obviously, the risk management is knowing how to manage that portfolio, knowing what to do in bad situations, knowing what to do in good situations, and a lot of stress testing. So making assumptions that, for example, the market, if it goes up 10%, or if a war is announced, what will happen to the oil price? What will happen if the oil price goes up 25%? And what will happen to my portfolio? So doing lots of stuff like that.
So you're obviously taking a macro top-down kind of strategy as a basis. What do you think of the kind of bottom-up strategy that might be used by Warren Buffett? Do you think it's outdated now, a little bit?
No, it's not
given
outdated.
Globalization and
It's not outdated. I think it's still important to have, even in a predominantly top-down approach, that you actually tick box and checklist the bottom-up fundamentals of the asset that you're about to expose yourself to. Because if you don't, and there's something significant there that you've missed, it could cost a lot of money. Sure. So, you know, the intrinsic value situation, you know, working stuff out like that can literally be putting some numbers in a spreadsheet just to make sure that you're not doing anything stupid. You're like shorting a stock that's at intrinsic value. You know, it can sometimes cost you a lot of money. So you've got to check these things.
Some more questions? Yep.
What do you believe are the biggest mistakes made by the 80 to 90% of traders that don't make money?
Believing all the bullshit in the market. So again, we're back to this conflict of interest. A lot of either bad people or people who are incentivized in the wrong way will either tell you lies or they don't know certain situations occur and they're just doing their job, but they're just a bit stupid. Yeah. Will tell you things that you want to hear all the time. You know, what people want to hear about trading is that everyone can do it, it's easy, and you can make $10,000 a month trading the international Forex markets if you follow this line on a chart. Yeah. Complete nonsense. So a lot of these people with conflict of interest will tell you that stuff, but it's obviously a lot more difficult than that. You know, trading can be straightforward, but you've got to take an approach where you've almost got to be very cynical and a little bit angry at the world, because the rest of the world is there to take your money, right? So if you're a bit cynical and a bit angry, it's a good basis to start trading, because you're going to question everything, every method, every system, every objective of individuals. You're going to question everything. That's a very good basis in life anyway, but especially in trading. So I think the reason why most people lose money is because they're probably too trusting. You know, what's the experience of people when they begin trading and they've never done it before? Sit down on their computer at home, type into Google, learn how to trade. What comes up first? Well, on the SEO, on the left-hand side of Google, it's all brokers, and they've all got a conflict of interest. And on the right-hand side, you've got paid search, where people are paying for you to click on that. Why? Because a certain percentage of people who click on that pay them enough money that they can do it again, right? So you've got to be careful. You know, you're not going to learn how to trade by going onto Google, typing in learning how to trade and going on 20 courses, 20 free seminars. What you're going to learn is a load of rubbish that will never make you money. And then everybody goes and puts money in their trading account and blows up, and they wonder why. And then they sit there for a year, save up some more money, and then do it again. And they never actually seek out a proper education. So that's why, you know, people are taught things like people are told what they want to hear, but also the assets that people tell you to trade and how they tell you to trade them is actually the reverse of what professional traders do. So someone somewhere within that company, probably the big boss, is making sure that that's what everyone is telling everyone to do.
Let's move on for now. We'll have some more questions at the end. So, what do you find yourself doing day to day when you're managing the institute?
Again, getting up around a little bit later than I used to, about 6:30 in the morning. Generally preparing for the market, just making sure the overnight news, what's happening overnight is not going to affect the overall exposure, the overall profit and loss of the community in any negative way. Yeah. When I say that profit and loss, I mean volatility. So volatility of the overall portfolio increasing too much. And we have like bespoke risk systems in the back, which which monitor and identify where the risk in the portfolio overall lies. So I can find out, if somebody's doing something that is contributing too much or badly to the overall performance of the community. So really, to begin with, it's about the community. That's what I'll spend the first hour doing each day.
And do you think now your work-life balance has reached some sort of equilibrium that you're happy with?
My private life is so much better than it used to be. I've just come back from like 45 days in Asia. Excuse me. I've just come back from 45 days in Asia. You'd never be able to do that if you were working at a corporate investment bank or hedge fund. You probably get 21 days holiday a year, if you're lucky. And the great thing about trading with your own money and managing a community that you can essentially manage remotely, you don't have to be in a physical location to do it. You have the freedom to travel, as you do if you trade your own money. So if you're not actually sitting at a desk working for a corporate where you have to be in your seat for a certain amount of hours per day, even if you've got nothing to do, you have to do FaceTime at the company and sit there till 7 o'clock because that person's going to sit there till 6:45 and you want to get promoted before them. Right? The great thing about what I'm doing now is I don't actually have to deal with any of that nonsense. So much better, much more freedom. I can go out on a Wednesday afternoon and play golf. I can go to Heathrow tomorrow and fly somewhere if I want to and take a few days off. Fantastic. Yeah, much better.
One last question I've got to ask. What's the deal with going to space? Why are you going to space?
Okay. I got a text message like March 2011 from a friend of mine who's like, he's in PR essentially. He's a bit of a sports agent. He used to be a sports agent. And he's Dutch and he moved back to Holland. Hadn't spoken to him for a year or two. He sent me a text message asking me if I want to be the first guy from Liverpool in space. So I thought, that sounds pretty interesting. So I called him and we had a giggle about it. But jokes aside, when I sat down with the company and I realized it was actually a very serious proposition. And the price of actually doing it was low because you're actually sharing the risk of the project. So I went in at literally the first stage of the project where it was almost like a concept where the space company had signed a lease agreement with the aerospace company that's building the shuttle. And looked at the project, looked at the risk, spent about 2 months going through what was essentially not even really a contract. I actually helped them create the contract because I wanted things in the contract. Yeah. That's how early stage it was. But then from that very first text message, what I kept thinking about all the time was, if I go to space and this is a reality, what would I actually do that's a little bit special when I go there? So I thought, well, why not think of something cool to do in space? So a group of us were having drinks one night in Mayfair, and one of my friends said, well, why don't you do the first trade in space? So I thought, okay, that's a really cool idea. So I called up the CEO of the space company and said, does the technology exist where I can press a button on the dashboard and send an order from space electronically to a piece of software via the internet maybe that will place an order into the market and trade? And he's like, let me check with the aerospace company. I'm pretty sure there is. So they called the aerospace company. A few days later, they came back, said, yeah, totally. We're now discussing sending tweets from space. So I was like, okay, pretty interesting. So I went for a holiday. This would have been August 2011 at this stage. Went for a holiday to Ibiza, and then booked a flight. Booked a flight to Amsterdam after Ibiza to go and sign the contract. because we got to a stage where the contract was pretty much exactly how I wanted it. Then went through the contract in their office and asked them to put one more point in the contract right at the very end. I think it was like point number 65. The company must provide the passenger with the technology that enables the passenger to execute the first financial transaction in space. So they took the contract in the back, wrote it in, and then I signed, transferred the money. Then went to Guinness World Records when I got home. They're actually based near Holborn. Quite an interesting outfit. Went in, made an appointment with the top guys there. Went to see them and just said, how about it? Can you give me the first financial transaction in space? Can you open this record? They said, no, because it's a first, which means it's unbreakable. Someone has to be able to break the record. So it was like, they're like, we only give a few firsts away per year. So it was like, well, if you do the highest as well, the highest trade that's ever been executed, then we can come to a compromise and do the first. So they issued and opened both records, and it took about 3 months of negotiations. So then they give you like guidelines of what rules you must stick to break the records, one of which is that we have to film everything from the cockpit live, and it has to be an electronic transaction. So we did a deal with YouTube, where similar to the Felix Baumgartner jump, the live jump that he did from 128,000 feet, we did a deal with YouTube that my flight will be live on YouTube, so everyone in the world can watch it, and everyone can see me hit the button and do the first trade. But we're going much higher than Felix. We're going 335,000 feet. Felix wasn't actually in space. So what he did was, obviously incredible. I wouldn't jump from 130,000 feet. but I'm going to be in a cockpit with one other person. So essentially, the pilot, who's an ex-NASA astronaut, and myself, I'm classed with the FAA as a co-pilot. So we had to do quite rigorous training to make sure that if anything happens to him, I might be able to find a way back to Earth.
What are you going to buy or sell?
Yeah, well, we're actually talking to sponsors at the moment. There's 2 types of sponsor that we've kind of identified that the project suits. Obviously, the first type of sponsor is a trading platform provider. So software companies that make trading platforms or brokers or even banks. So those guys, we don't want to really trade if we only have one of those sponsors, a stock. Because if you trade a certain stock, you're giving free advertising to the company whose stock it is, right? So, and it's obviously worth something if you trade their stock and there's millions of people watching live on YouTube. So if we do only get a software provider, trading platform or broker, we'll just trade a currency pair. So we'll probably trade sterling US dollar. But if we do actually secure a corporate sponsorship where they're paying us to basically, out of their advertising budget, to trade their stock, then we're going to trade their stock. But what we intend to do is make sure, that they're pretty decent trades, size-wise, and they get global exposure.
What's the volume, you think?
I think currency trades, certainly $10 million. For a stock, maybe $1 to $2 million. But they have to be decent, decent, yeah.
Any more questions? We'll just finish up after a few more. Yep.
Given the structural decline in the financial industry, would you still go into trading now as things are? What kind of advice would you give to people?
Yeah, personally now, if I was 20 years old and had the knowledge that I have as a 34-year-old about the industry, if I was to go into an investment bank, I'd go in for a couple of years, but with the target of not being trapped within the investment bank, and you won't be trapped anyway, which is a good thing, because, and this is very, very important for you to understand before you ever go into the industry. When you go and work for one of the investment banks, the first 2 years you're not on a permanent contract. You're a 2-year contractor. You're not even an employee of the company. And I was that at Goldman Sachs, for 2 years. And you go in as a financial analyst here. And then when you're promoted to associate, that's when you're actually a full-time member of staff. So what you'll find is lots of people on the trading floor who are all financial analysts. They're actually, there's hundreds of them, globally, just walking around the offices doing projects, being paid very little for a lot of work with not great career prospects. My day in 2002, 2 years after I joined, 8% of the original analyst program was still working at the company 2 years later. So what I would do is go in, get the experience, and actually leave and seek to go to a hedge fund as quickly as possible. Or move out of the country and go to an emerging market or a frontier market. But go and learn where the infrastructure is, where you can learn. But don't think you're going to get paid, because you won't. It's crazy that there's guys in the industry now where they've got masters, PhDs, MBAs, and they're going in on programs for 2 years, and what they're getting paid on an hourly basis is half what you get paid in McDonald's. So you get guys in corporate finance who are working 90, 100 hours a week, and their per hour salary per annum is £6. That's half McDonald's. It's half Pret-a-Manger, right? It's crazy. So I think people have to realize this and wake up to the reality of the numbers, that going to work for these places now isn't going to make you very wealthy in a short space of time. Nowadays, you go for a very long career. Expect to be there for 15 to 25 years before you can actually consider yourself a wealthy person. If I was 20 again, I would go in for a couple of years and then go out to emerging and frontier markets, or try and get straight into a hedge fund at the youngest possible age. I hope that answered the question.
Yeah.
So do you think that the 2-year training that you get at the bank is the best? I mean, is it worth training an investment bank for 2 years? Or you can get a bit of training somewhere else?
No, I think we've got to define what the training actually is. Your training isn't you waking up in the morning, taking your rucksack and your notepad and going into a lecture theatre, and then traders are coming in and teaching you how to trade. You're on the desk. You're doing your job. You've got your hands to the pump. You're part of the desk. So your education and your training is actually on the job. So it's good to do it, because you're kind of like riding the wave of the current market environment. And you get your hands dirty and you learn everything inside out. And as long as you keep an open mind and work hard and learn that stuff, it's a good education. But don't go in with the unrealistic expectation that within 5 years you're going to be a multi-millionaire and you're going to be the hottest kick-ass trader in the market, because it doesn't exist anymore. You've got to go to a hedge fund for that. Like I said earlier, what's left at the investment banks is what 5-10 years ago was the bad stuff in the company. So you've got to go in and really have a bit of self-interest and learn about the industry while you're doing it, and then keep to your own objective. Don't let the relative measure of, well, I earn £100,000 and the national average salary is 35. Don't let that seduce you into staying at a firm. It's too safe. You'll just end up with liabilities for the rest of your life. You'll be trapped.
Okay, guys, I think we'll wrap it up there. I hope you've all enjoyed it. If we could just give Anton a nice round of applause, please.